Hey everybody, welcome to the live stream. I just did a video on Hanesbrands, ticker HBI. And I didn't realize how much the stock has come down because I was looking at trending tickers to see kind of what people are looking at. And I saw this Hanes come up, which I thought was odd because that's kind of like a ticker that just most people don't really look at. Like it's one of those big companies that people just kind of, it's just part of this. It's part of our society. It's just, it's been around over 100 years. It's nothing special or exciting, but I guess there's concern that they will go out of business, and I think it's priced that way. Not just the stock price, because ironically, it's trading almost exactly where it was when it first started trading. It first started trading in the low fives. This is, it didn't actually trade in the low fives. It's due to a stock split. So probably IPO'd at 20, but due to a 4-for-1 stock split, it came down to 5. But it's right back there. It's exactly where it's trading at when it's IPO'd. Its all-time low was, I think, $1.35 in 2020. Everything, not 2020, I'm sorry. I think 2008, the Great Recession. Came down really low in the Great Recession. And it got over $30 in 2015. And then COVID came, it came down to $7, $8. But now it's even lower than COVID levels. Is anybody following the stock? And if you want to be in a live stream, you don't even have to know that much about finance. You can click this link. You should see it on the bottom of the screen, or if you look in the comments, and then we could just talk. And I'm sure you're going to learn a lot. Yesterday was a good live stream. That guy Raider had some pretty good insights. So back to Hanesbrand, I think the real concern is the debt. They it's easy to see on Simply Wall Street. Their debt is getting a bit high. See, in 2013, debt to equity was pretty close. Debt was always higher than their equity. Red line is debt, blue line is equity. But as you can see, it really broke apart. And now their debt is $3.3 billion with $400 million of equity. And it's not an issue if a company has a lot of debt. It's an issue if they can't pay the debt. Debt is a great tool to grow and scale a business because it's very cheap financing. The problem is with debt is that you have to pay it back. You have to pay interest on it and pay it back. And if you're paying a 3, 4, 5% interest rate, you're probably in fine because you probably can get a return higher than that. Like if you took $100,000 of debt and say you were paying 5% interest. So that's your annual rate. So $5,000 of interest you have to lay out. But if you use that debt to say buy a machine or buy a business, and you were getting a 10% return, you're making 5% on the debt. So it's good debt. That's the kind of debt you want. But of course, if you're yielding under 5%, it's bad debt. Or if you're using the debt to pay old debt or to maybe pay a dividend, you might put yourself in a kind of precarious situation, because then you're going to be loading up on debt. So I think that's the big concern with this stock, is the amount of debt they have. And you would think a lot of people look at the price multiples. Actually, let me show you on the chart on the industry. Hey, D. Lopera, what's up? Thanks for commenting. Let me show you the industry comparison. This is where people, I think, make mistakes. Even people comment on my videos. Because I remember saying, okay, so if you look at the PEs in this industry, they're not too high. But if a company has like a PE of 50, 70, 100, that indicates the market feels the company will grow a lot. That's the only reason the PE gets really high, when the market thinks there's going to be a lot of growth in the future. And people think the opposite when they see the PE or price of sales. They think the lower the better. And in theory, the lower the better. The more valuable, the better deal you get. But let me see if I can explain what I mean. So PE is, this is hard to write on. Okay, so PE. So it's pretty much, it's market cap over earnings. Or it's stock price over earnings per share, same thing. Let's do stock price, because I think a lot of people have a hard time thinking of it as market cap. Because people don't really, a lot of people, I think, don't even look at market cap. They look at stock price. If the stock price is 20 today, and it's 25 tomorrow, they're happy. If it's 30 in 6 months, great. If it's, as long as it goes up, the stock price goes up. But you have to look at market cap, because actually the stock price could go up, but the market cap could go down. If they're doing, if they add shares, buy back shares, they do splits. So market cap is the value of the company, not stock price. But I understand why people think that. So EPS. So if a company's stock price is 100 today, and its earnings per share is 20, and anybody wants to be a guest on the live stream, you're more than welcome. It's a great learning experience, and don't feel intimidated. You can click on the link. I put it in the comments. So that's a really low PE. And when analysts say this company is trading at 5 times earnings, this is what PE means. In this case, they're trading at 5 times. Their stock price is 5 times their earnings. It actually took me a long time to figure out what they meant. Like, I always heard they're trading at 6 times revenue. They're trading at 12 times free cash flow. And I never understood what that meant. It took me a long time to figure it out. And let's say the stock price, because earnings doesn't really change until the quarter, right? Every quarter it changes. So let's say the next day the stock price, or next week, if you want to say, the stock price goes up to 120. So it's more expensive. Hey, Quogs, what's up? Now they're trading at 6 times earnings. So it's less attractive, right? And let's just say week 1, week 2, because earnings doesn't change much. It changes like every quarter. So but the EPS or all the price multiples are constantly changing. They're constantly moving. So the stock price keeps going up. The PE appears worse, right? So so if you want to buy a stock and you see it's $100 stock price, you say, wow, that's a great PE, 5. So, but you decide not to buy it. Week 2, you look at it again, it's 120. Like you kick yourself a little, like, oh, I could have made 20%. Wow, that's a lot for 1 week. And the PE is getting worse. It's up to 6, up to 7. Now it's up to 8. So then why do people buy stocks when the PE gets higher? Why doesn't everybody just buy stocks when a PE is like real low? Because the higher the PE, the more growth potential. That's at least what the market is saying. Because if a company, let's just do a more extreme case, like a tech company. And this happened with Amazon. This happened with even like Microsoft. They were like, they weren't even earning much. Sometimes they weren't earning anything, but we can't look at the PE with negative earnings. So let's just, like you see this is a tech stock, like a really hot tech stock. NVIDIA is actually, ironically, I'm new, by the way. Welcome, Quags. If you want to join the live stream, you'll learn a lot. But I know it's a little intimidating, but welcome. So this is like a hot tech stock, and PE is 15, which is not high at all. But there's so much excitement about the stock. Maybe it's the 1990s and it's a .com company. Maybe it's 2011 and it's an EV company and the EV boom is starting. Or maybe it's 2023 and it's an AI company. So what happens? The market drives the stock way higher. Like it just keeps going up. It goes from 300 to 500 to 800 to 1300. And the PE went from 15 to 65. So why do people keep paying for the stock? Well, there's usually 2 reasons they keep paying for the stock. I think they're just hoping to make money on the excitement of the stock. If this is an AI stock today, they're not looking for a long-term investment. They think, okay, this keeps going up, so I'm going to buy it and as a swing trade, and I'll sell it like next week or the week after. I just want to make my 20%. Hopefully, you didn't time it wrong, because if you buy it today and then it starts dropping again, you may never make your money back. But people are just but hopefully people watching this aren't swing traders. Not that it's a bad thing. It's just I don't really have any clue how to time the market in that way. I feel it's a lot of luck. So if you're going into it thinking, I do see the potential of this company. I do think when they report their earnings, they're gonna kill it. They're gonna crush it, like NVIDIA has been doing, doubling, tripling revenue and earnings. So they buy it with the idea that they're gonna come through, because a company 65 isn't even super high. But what if it had let's just say they had actually their earnings were even lower. They were 10. So 130. We even saw like Tesla was like trading at 300-400 times earnings. So why would anybody ever pay that much money? It's just the market just felt, or at least it was, and the market's wrong oft a lot. You just don't see it. You always see these stories of how Tesla went from this not a big company to $1 trillion company. Same thing with Amazon, Google. But for each Tesla, Amazon, Google, there's 1,000 companies that ended up going pretty much bankrupt. Like they got bid up real high, and just they never delivered. And then whoever invested was toast. They lost either everything or. Let me know in the comments. Is there a stock that you went heavy on? Or maybe not even heavy. You just threw in a few hundred or a few thousand, and you got burned. You lost like 90% of your investment. Or maybe you got out of the stock before it crashed. So that's what happens a lot. Like there's so many stocks that people are bidding up, and only like maybe 1 out of 10 or 1 out of 20 are going to be around in 10, 15 years, and are going to have a significant market cap. But we never talk about the stocks that end up kind of crashing down. So, and if you look into a company, right before a company goes bankrupt is when they have the best price multiples. Like look at, they have a really low price of sales, 0.3. So they're trading at 1/3 revenue. So their market cap is 1/3 their revenue. Like Ralph Lauren is trading almost at 2 times revenue, meaning their market cap is about double their revenue, because you can see their price sales is 1.8. You said in your summary that even at a PE ratio of 0.3, investors still aren't interested in buying. Some investors are highly motivated to buy under such levels. Maybe there is a big red flag. Yeah, well, when it's a really low price multiple, unless like the market is pretty much saying, I'm not touching this stock. That's why it's such a good value. Now, if you can kind of like cut through the minutia and figure something out, you could make a lot of money. It's hard to do. It's hard to go against the market and win. But right before a company goes bankrupt, like I use this analogy. Like if you look at a company that like made VCRs, and like their market cap was like say $1 billion. And their revenue was like $500 million. So they're trading at 2 times revenue because VCRs were popular in the 90s. But the problem is revenue. Revenue lags. So if like what, I don't know what year did DVDs come out, when I started getting popular. I think it was the late 90s. So there's always going to be like a and let's just say the market cap I got murdered on China Mobile when I was first starting investing. That'll do it. Like when you invest, when when you invest in a stock and it does really bad, you hate that stock no matter what. And vice versa. If a stock does really well, you love that stock and you're kind of married to it. I know how you feel. But generally, China Mobile. And let me look at that company. Just curious. But has anybody looked at Hanes? China Mobile. Oh, they got delisted. That makes sense. But let me know if you guys are looking. I looked at Hanes years ago. They were a lot better years ago. And let me know if there's any tickers you want me to do a DCF on. Because it's still kind of compelling because it's like this is their they just released at 10K. So it's like you see 5.6 billion of revenue. That's a pretty big number for a company whose market cap is under 2 billion. Because you see these kind of these startup companies or these companies that even don't have really even much of a product out there, and they're trading at 20, 30, 40 billion of revenue. So you say, remember what like those EV companies that were trading? I've been seeing Rivian twice last week. I saw somebody in front of me driving a Rivian. So Rivian's 11 billion. So that's not too bad. It's not as bad as I thought. I think it's not as overvalued anymore, but their market cap is about 3 times their revenue. So they're trading at 3 times revenue, which isn't that bad. I think they were trading probably at like, a couple of years ago in 2022, they had 1.7 billion. I bet you their market cap was much higher. Okay, so they're trading at $11 a share now, and then it's hard to see on this. So in 2022, they were trading at 80. It was over 100. Did they do a reverse stock split, Rivian? Hey, Mike, what's up? So they're trading at 130. How would they must have done a reverse stock split. I mean, no. How do they, nobody trades at 130 IPO. I don't understand this, but anyways, but the point is they're trading at 11 now. So in 2022, they were close to 100. Actually, I think they might show they might show the price of sales. Okay. So they're trading at 2.5 times revenue right now. They were trading at 16 times revenue in 2022. And it's not like their revenue, and this is not improving because their revenue is going up. It is going up, their revenue, but their stock price has come down so much more than their revenue has gone up. I mean, that stock price was over 100. Now it's 10. So it's down like 90% from the peak. So their revenue, so from 2022, because you can't really compare to 2021, they just started. So 2022, so they tripled revenue in 2 years, which is good. They tripled revenue. But their stock price is down like 90%. So their stock price came down a lot more than their revenue went up. That's why their price multiple, their price sales is is so much more attractive now. So if you just look at the price to sales ratio, if that's kind of your indicator whether you should buy or sell a stock, Rivian was a terrible buy in 2022, and it's a much better buy now. I still don't think it's a good buy at any point because I don't think it's a good company, but generally when it's a high price of sales, it should go up in price. A stock should perform a lot better when it has a high price multiple than when it has a low price multiple. Unless the market is totally off, which it was in this case. I wish they go back further on these charts. Because I don't think we're going to get a good read on Tesla. What's the price sales in Tesla? So it's kind of like a barbell. It was 6, then it got to 11, then down to 7. And the PE, they still have pretty high PE, 47. It was 80. But Tesla is really the only EV company that's done well. They have a lot of revenue. They're profitable, which is amazing how profitable they are for a car manufacturer. I mean, they're not like as profitable as because they have a lot of $100 billion of revenue is nothing to sneeze at, and $15 billion of net income. So it's 15% margin. But if you look at like Nvidia has like 50% net profit margins, which is just unbelievable. That really surprised me. I did not realize how profitable a fabless semiconductor company can be. But then it hit me, because fabless, if you guys probably know this, but Nvidia is fabless, and then Taiwan Semiconductor, they're a foundry. So they figured it out. I mean, that's why what's it called? That's why Intel is just doing terrible, because they're both. They're fabless and a foundry. So just all fabless means is that fab is fabrication. So it's like a manufacturing of the semiconductor. So they fab less. So they don't do any manufacturing, or they do some, but they pretty much don't manufacture the semiconductor chips. The foundries do all the manufacturing. The Taiwan Semiconductor pretty much manufactures all the semiconductors for Nvidia, which it's a real specialty, manufacturing semiconductor chips. It's much more complex to manufacture semiconductor chips than most things, even computers, because the chips are very it's very expensive. The machinery, it's not like manufacturing like chairs. Like anybody can figure that out. I mean, not anybody, but if you know about manufacturing and you know about like how to build things, you can figure out how to manufacture a chair. But to manufacture a semiconductor chip, it's very specialized. You have to have special knowledge and skills. It's watch a YouTube video. I couldn't even like explain it enough to convey the point. But watch a YouTube video on like how do you manufacture semiconductor chips. They went bankrupt, and if the co-founders F things up. That's something I have a hard time with. How do you look at the management and know whether they're good or not? It's a little confusing, because every time you read on paper, they always seem like they're amazing. They have they're so brilliant. They know so much, but maybe you got to dig a little deeper. Waste Management, that's an interesting company. That's a company I never really looked into too much. But let's do a DCF on waste management. So 206, 83 billion. That's a good industry to be in, waste management. There's definitely a good amount of demand, a really high WACC, which is not the greatest sign, but and they're like the top of the heap, right? For waste management, aren't they? Like, if they're not the top, they must be like the top 5. So how do you value a stock or a company? Well, you have to estimate the future free cash flows. I could estimate it based off of previous revenue. I could estimate it based off of revenue forecast, but analysts do provide future free cash flows. New to your live stream. Thanks for the info. Made some money on Lunar and Sound. Wow, nice. Lunar, you made money. Himax is fabulous. Yeah, Himax is a good company. That's an interesting trade. I think that has a lot of upside potential. There's a lot of country risk with that stock. So let's just use the analyst future free cash flow estimates. 2 billion, 2.8 billion, 3.4. And we could always massage these numbers. Some of those seem right. 2, 2.8, 3.4. Oh, right here. I did an FX rate. I think the WACC is a little too high. I'm going to lower the WACC. So another thing to consider is a dividend. So if a company's paying a dividend, I think it gives a little more benefit to you, the investor. So if it's overvalued, if they're paying a dividend, that could subsidize for the overvalued for paying more because they're giving you back money, which they are, but it's still kind of overvalued, 120, which makes it. But like I said before, if I calculate a stock as overvalued, there's plenty of stocks I bought that I consider overvalued. And there's plenty of stocks I would not buy because the DCF model is just one way to identify whether you want to buy a stock or not. It's so hard to predict the future, right? So I'm at 120, which is where they were trading at before the COVID run up. So that was I'm calculating their levels back here. So who cares if somebody says a stock is overvalued? If you already made, all your money back in dividends and you're double in price, you're doing fine. Because if you bought a stock for like $50, you owned it for 10 years, and you already made you made $50 in dividends, it's all free money after that. Of course, you want it to go up. You want to 10x, 50x your investment. We all want to make as much as we can, but as long as you got your money back and then some, you're doing fine. Because we can't put all our money into Nvidia. Like who would have known that, right? But let's see in like a couple of years or even a year, because some people. I know some people would have, unless you got into Tesla early, but let's just say you got into Tesla at 300, right? And then you're up 30% after 6 months or 10 months, you're up 30%. So you're like, I knew it. Tesla's a winner. And now you're down 30%. So it's hard to, in a moment, it's hard to focus on stocks because you're always going to look back and say, oh, I should have did this, I should have did that. But if you notice that if you were in the stock for a number of years, where would you be? And if you pick winners, you generally should do fine. But if you pick these crappy stocks, you're going to lose a lot of money. Rocket Labs will have potential growth in the future. I know they had a couple of failed launches. No, I don't think so. I don't really. It's hard to monetize what they do. It might be hard to do a DCF. Let's see. Let's do a DCF and then talk about it. So they're projected to have negative free cash flow for quite a while. So we have to do a regular DCF. Okay. 454, 2.2. %. So it's at 9%. Okay. 0.4, 0.6, 0.4, 0.6. Let's do 1 billion. Yeah, it's going to be hard to. Yeah, we're not going to be able to evaluate this way. We have to do a lot of estimation. Yeah, that's a good estimate. Rocket Labs. Let me know if iRelevant is here. iRelevant 9114, because he asked me a question about asset impairments, and I said join the live stream because it's hard to explain certain things over. So this is a total guess on their future. I'm at 754, but I wouldn't even. I'm gonna raise the WACC because I think it's a more risky investment. Okay, I'm at 562. Now the problem with these companies is it's hard to monetize what they do. They do have revenue. How did they get 245 million of revenue? Because I think a big selling point with these companies is that they could bring people to the moon, kind of like bringing people to other countries in a plane, but they're going to bring them to the moon. And obviously, it's going to be really expensive. But that's going to take a really long time to happen. And let me know if you guys want to go to the Berkshire annual meeting. If you guys want to meet up in Omaha in April, I want to go. I haven't been, and I want to go before Warren passes. That'll be a fun. And you only need to own one B share to go. But if you don't, I own a share, So I can invite up to 3 people. Yeah, what I was saying is it's these companies, it's such a big hurdle to make revenue. It's not like if you open a grocery store, it's very easy to generate revenue. Lots of people are going to buy food from a grocery store. There's not much of a barrier. It's very easy just to buy the food and put on the shelf. In their case, they have to do a lot of work to start scaling to get to the point where they're getting revenue. They have to build rockets. There's a lot of legal stuff they have to get approval for. You can't just bring anybody in a rocket ship. There's a lot of liability. Most of their revenues in the US, they have Canada, rest of the world. But I want to know what the revenue is. Like, I'm not even sure. Does anybody know like how they generate revenue? Because that's not bad that they have 245 million of revenue, 2.2 billion market cap. So they're trading like 8 times revenue or something like that. 9 times revenue, which isn't a great price to sales ratio, but for this company, I'm surprised that they even have any revenue. Revenue increased 33 million. Launch services revenue was 72 million, an increase of 11 million. Launch services. So are they bringing people to space? With 10 launch missions completed in the year end. Because a lot of these companies are getting funding from the government. They might help put satellites into orbit. I heard they signed a $1 billion contract. Okay, there you go. That's another source of revenue I wasn't thinking about. I know they do get funding from the government because the government, especially NASA, really wants to explore outer space and the moon. They want more information. And it's hard for a government agency like NASA to just they can't just say I want $50 billion. So give me $50 billion, the U.S. government, and we can start doing more missions. It's hard to get funding. It's not that easy. But when you have a private company that does all the work for you, it could make it easier to get that information. Okay, let's see. What do you think of PLTO? Yeah, I don't really like these space companies. I just think it's so premature, and I just don't see, unless it's a swing trade, I can't see the long-term benefit. 7.5 million per launch is cheap. It's cheap. It sounds like a lot of money to me, but yeah. PLTO, a PTLO, or Portillo's. PTLO. The first thing I think about when I invest, before I even get into like the financials, the first thing I think about is like, and that's why I like I always said Meta and Costco. I was really bullish on Meta and Costco for a long time now. But the first thing I think about is that does what they sell or the service they provide, does it make sense? And if it doesn't make sense to me, I'm talking about as a business. Like you can open a small business and sell anything you want if you just want a business where you can like support your family. That's a lot different than opening a business where you have investors and you need to provide a return. So does it make sense? And so that's why the rocket thing, it's just like, it's such a stretch for me to see the connection between how it's going to be a profitable business. Where like Portillo's, that makes sense to me. And I'm not saying every business that sells food or is a restaurant is going to be profitable, but at least the business concept makes sense to me. Now you have to look a little deeper to see if how they run the business, if they run it well, and how they've been doing historically. That's the hard part. Is running a good business. This 11. I'm trying to do more small cap stocks on my channel. See, they don't have, so I have to do with my older model because 11 whack. Is that what I said? 11? 11. Portillo's. Okay, 793, 1426. They do have positive free cash flow in 3 of the last 4 years, which isn't too bad. Revenue looks good. It's on an upward trajectory. Let's see their future revenue, because free cash flow, the future looks kind of negative. So that's going to be, so we have to calculate the free cash flow based off the future revenue. 760, 850, 1 billion. Okay. Dex, what's up? Whack. Okay. Okay. So if I looked at their future revenue projections, which they're projected to grow from, they had 680 in 2023. It's projected to be 760 million next year, then 850, then $1 billion. So if they do that, and I'm also assuming they convert 8% of their free cash flow, 8% of their future revenue to free cash flow. That was their best year, and I think that's 2020. They had 37 million of free cash flow, 455 million of revenue. So they converted 8%. So if they do that again, like in the future, I'm at $17. Those are a lot of big ifs. I think it's more likely they're going to be at 6% cash flow margin. So I'm probably going to say it should be 13, the stock. So it's not trading too much different than what, but that's only one measure, and are doing it with that much debt. Their earnings to allocation this year. So Portillo's, well, debt isn't too low. They have 300 million of debt. Let's see how much cash they have. Yeah. Sean, are you talking about Portillo's in terms of debt? They have a good amount of debt. They're, I don't think I would say they're low debt, but it's no problem. That's not a bad thing, as long as they, like I said, as long as their return on the debt is higher than the interest they're paying on the debt, it's fine. Another thing I do, just to read about the company, just to understand it a little better, before I get deep into like the financials. Asmin, what's up? So they've been around a while, a little over 60 years. So that's a positive. It's a I don't know if I've ever been to one of these. I don't think I've ever seen it before, but I've heard about that company through the stock. Fast casual restaurant chain based in Chicago. Chicago style food such as hot dogs. The company was founded by Dick Portillo. In addition to 46 locations in Chicago and Northern Illinois, 6 in Phoenix, so 86 locations. So it's not a huge company. 86 is not a. That's why it's such a low market cap, 790 million. But it's not bad. 86 locations. Okay, so in 2014, they sold the company to Berkshire Partners. Nothing to do with Berkshire Hathaway. The new owners are planning to open 5 to 7 restaurants each year. They've been buying the land for new sites. That's something to look at. That's why McDonald's is so valuable. They're the largest landowner in the world, or one of them. Because they own, what they do is they buy the land and then they lease it to the franchisee, because McDonald's doesn't own any restaurants. They franchise all restaurants out. So the franchisee owns the McDonald's they're in, and they pay a royalty to McDonald's. And McDonald's makes money on the real estate because they charge the franchisee pays lease payments to McDonald's, and then eventually McDonald's owns the land once after maybe 20 years or so. So Portillo does it too. So Portillo has been buying the land for the new stores and then leases back to the company, which is a great business model because it's not like you're doubling up. You're getting your royalties from your business and you're getting equity from the land. And as you know, land is very good asset to have because generally it's going to go up over time. And even if it doesn't go up too much over time, once it's paid off, then the lessee, the owner of the Portillos, is paying them still. They're still going to pay to lease the space, and it's all profit at that point. So if you want to be rich, be a real estate developer. It's not easy to do, but so they went public in 2021, so it's pretty new. Its IPO offering sold 28% of the company as stocks traded. What does that say? Its initial public offering sold 28% of the company as stocks traded on. Doesn't sound like English. On the NASDAQ with private equity firm. Okay, so the private equity firm Berkshire Partners kept 72% of the company, and they sold 28% of the company. That's the thing. When you go public, you don't have to sell your entire company, because going public is selling your company. You're giving away your company, but you can maintain 10% of the company. You can maintain 90% of the company, whatever you want to maintain, but you have to sell at least some of it. So Berkshire Partners owns 10%. So maybe they IPO 28%. So maybe this is when they first IPO'd, Berkshire had 72%. Maybe over time they sold more and more of the company because they only own 10%. Maybe they sold 9% to Orbis Investment Management. I mean, that's generally what you do. You go public, and then hopefully the stock price goes up. Which it didn't really in their case. Hopefully you go public and a stock 10x's, and then you become like a multi-billionaire. In their case, the stock went down almost right away. It went up a little bit. Well, it doubled. Let's see, 37. So it went up about 50% after a month, and then it never got to that point ever again. I wish they made these charts a little easier to read. There's so much stuff in the way. Okay, let me do that. So mid 2022, it reached 15. Beginning of 2023, it reached 16. So now it's pretty much trading on its all-time low. How is PetMed Express performing? Oh, it's awful. Sometimes you just gotta, you pick losers, but you wait it out. I remember Meta when it was down. I put a lot of money into Meta in the beginning of 2022 because I sold my business and I put a lot into Meta, and I was down 70% at one point. And now I'm up. Now it's one of my better performing stocks. Now I'm up about 60%. So it came all the way back up to break even. Then it went to where I had a 60% profit. So if it's a good stock and you wait long enough, you'll make money. Okay, they don't franchise. Okay. So the new owners are planning to open 5, has been buying the lamps new site and then leases back to the company. Okay, so Berkshire Partners, that's their business model. They own, like, I'm sure they have a lot of subsidiaries, like many companies beneath them, Portillo's being one of them. This is what like private equity firms do. They buy the company, and then they're buying the land. Yeah, it's private equity, Berkshire Partners in Boston. It's invested in 100 middle market companies. So yeah, so you invest in a lot of companies, and even if only 2 or 3 become big, you can make a ton of money. I'm sure some will definitely go bust, and some will just chug along, give you a 10-20% return each year. But you can't pick all winners. Even Warren doesn't pick all winners. Oh yeah. So somebody asked me, somebody said on my Berkshire video, he said, like, besides, I don't know if he was trying to be like sarcastic. It was hard to tell, but I think he was just genuinely curious. He's like, so besides Apple and Coke, what else do they own? So I just found a website that listed all their stocks, and I kind of parsed out the data so I can put it into a nice format. I don't know why it's crossed out on here. This is weird. But anyways, so this is pretty much their public holdings. Berkshire. The big one by far is Apple. And they're up 350%. I think so. I think they invested about $30 billion in Apple, and that $30 billion is worth $170 billion today. But they put more in. Like, their cost basis is 40, but they bought Apple with a cost basis of like 10 and 20. But they kept adding to their Apple. And I think often Berkshire wants to get 9.9% of a company. They don't want to get 10% because I think then they have to file with the SEC or something. And so it's just easier to do 9.9%. But that's by far their biggest. Even though Apple's kind of flat the past 6 months, which did anybody realize, like, Apple and Google are flat? Like, the market is at all-time record levels, and people, and the fact that the biggest company in the world, well, now they're the second, but 6 months ago they were the biggest, is like down, and the market is still at all-time highs. So you don't need these massive companies to do well, as long as you have other massive companies doing well. So the the Fab 7, or I don't know whatever they call it, the Super 7. So in who am I missing? Okay, Meta, Amazon, and Netflix, right? Wait, do I have Amazon? No. Amazon. God, I wish I put more into Meta when it was lower. It kills me. You're never happy. I'm never happy if I make money or you lose money. I'm never happy. I just wish when I make money, I'm so mad, and then put more into the stock. And then when I lose money, I'm just mad I invest in the stock. So in 6 months, I wish this. So in 6 months, it's not that easy to read. Okay, so this blue line, there's so much space. I wish they would. Okay, so this blue line is Apple. So in 6 months, Apple's down 5%. They're actually down, which is just crazy. And this red line is Google. Maybe I'll change the color for Google. It's hard to say. Let me pick the yellow. Google is up 1% in the past 6 months. That's hard. So, and the winners are NVIDIA and Meta. They're both up 70% in 6 months. I thought NVIDIA was up more, right? Netflix is up 40%, and Amazon is up 29%. So it's crazy with Apple and Google flat or down. The market is still breaking records because of companies like NVIDIA coming up. Meta still doing well, and there's a lot of mid caps like the $30 to $50 billion range that are trading at all-time highs. This happens with me too. I always feel bad after making profit. It's funny. Like we're never happy. Of course, 2 years. In 2 years, Apple is up 10%. Is it which is crazy, right? You would think Apple would be up like 200%. It's only 10%. I'm missing Microsoft. I knew I was missing somebody. Okay, here we go. So what's Microsoft in 6 months? Microsoft is up 26%. Microsoft and Amazon up the same in the past 6 months. But in the past 2 years, Apple's only up 10%. That's crazy, right? You would think they'd be up a lot more. The Amazon, I bought Amazon on my wife's account, and I feel bad. It's just, I bought it like in 2020, and it's only up like 40, 50%. Like it's not moving. Amazon 21% in 2 years. Microsoft is doing better, 43%. That's why Microsoft is the largest company now. They took over Apple. Netflix is doing well. I also bought Netflix for her. That's up like 50, 60%. Meta's crushing at 145%. And of course, NVIDIA, 245%. They're just on another planet. But if you go back 5 years, Apple is up the most, excluding NVIDIA, because NVIDIA is up 2,000%, which is, so I'm going to take NVIDIA off the screen because it's hard to look at the screen. So if you give yourself a long enough time frame, you'll make a lot of money with these stocks. Apple is up the most, over 300%. And then Microsoft, 270%. Meta, 200%. Where's Somebody's missing. 2, 4, 6. I only see 5 numbers. Microsoft, Netflix, Amazon, Meta. Oh, Google. I don't see Google. This is weird. Let me change the color. I'll try the other Google, I guess. I wonder why Google didn't show up. Okay, here's Google. 139%. But that's why people are always focusing on these mega caps, saying, oh, 1/3 of the market gains is from 3 companies. Because when these companies go up 20, 30, 40%, it's such a huge number. And when a $50 billion stock goes up 20, 30%, it's not that big. It doesn't move the market. But when you have $1 trillion stock going up at these levels, it's just the number is so massive. Apple, 2, 4. Oh, right, Netflix. I'm putting Netflix instead of Tesla, right? Oh, what I know, it used to be Netflix. Okay, let's go back to this Berkshire. So he's up 350% in Apple. And that's why his portfolio ballooned. Besides being a brilliant guy, if it wasn't for Apple, that really drastically increased his portfolio. And sometimes I kick myself when Apple goes up, saying, "Oh God, I wish I invested in Apple." But if you invest in Berkshire Hathaway, half of your investment is Apple. So if you put $10,000 into Berkshire, it's like you put $5,000 into Apple and $5,000 into a lot of other companies. So his second biggest holding is Bank of America. That's up 33%. It's not that much. I'm not sure about the time frame, but he gets a lot of dividends from some of these stocks, because tech stocks most of them don't pay dividends or pay a really small dividend. So you're going to see a lot of price appreciation. But when you receive a dividend for 50 years and you build in the dividend, he's probably up like 500% with the dividend on Coca-Cola. Exactly. BRK is like an ETF, exactly like an ETF. Chevron, he's been really, really putting a lot into Occidental Petroleum. He likes that. Kraft, wow, look at his Kraft. It's down 55%. But like I said, if you include the dividend, I bet you he's not even doing that bad in Kraft. I did sell my Kraft. I tried to start increasing my Kraft position, but I end up selling it. Did you sell pets? No, I didn't sell pets. I still have faith in pets. Kraft has been losing a lot of market share recently. That's been struggling. So it doesn't look too bad. It looks like it's come up since the bottom. I mean, it's still lower than 2021 levels, but it was getting kind of low. It was touching 30. Do you guys look at RSIs? So usually if an RSI is below 30, that indicates it's a good time to buy. And if it's above 70, it's a good time to sell. So RSI builds into the calculation not just the stock price, but also the buying and selling activity. And it's supposed to be a deeper calculation. The problem is the RSI can stay at a low level for a long time. VWAP. I don't look at VWAP, but I'm trying to get into those indicators more. Let's see. He's up 110% on DVA, which I'm not. What's DVA? Oh, DaVita. Kroger, he's up 53%. He has 2.2 billion Kroger. Visa, MasterCard, he's up 680% in MasterCard. I'm surprised he's up so much in MasterCard. Yeah, I'm familiar with it. I just don't use it much. That has an RSI above 70, so that's a big sell. Look how much MasterCard is up. Is that because of AI? Is that because of wow, it's really up a lot. So that's the thing. You buy Visa, you buy MasterCard. Oh, Visa's up 460%. That's nothing to sneeze at. Amazon, he's up 114%. So he must have got that like 8-9 years ago. How about contrarian strategy to buy Warren's losses? He's only up 20% on new. I'm surprised. I thought he was up a lot more. I'm up about 115% on new. That's one of my. I'm happy with that investment because it's a little outside my normal investments. I don't usually invest in banks or fintechs. So I'm happy with that return. But who knows? Maybe a couple of years from now, I'll be down. But the thing you have to remember, he owns 18 billion of spiders, 18 billion of VU, which is the same thing as spiders. But the thing people don't realize, when you just look at these returns, they do look pretty impressive. But he also gets a lot of dividends, and he 59.61 NVR. NVR. That's a $7,000 stock price. Wow, it's an expensive stock. He owns a lot of private companies, so you don't really have a valuation of private companies. Like Geico is a big company, so it's not like it's actively traded in the market. So you have no idea the value of it. He does because he has all the financials. But so he owns that, but he owns like he has a big portfolio of insurance companies, and insurance companies have a lot of float, a lot of premium. So people buy their insurance policies, and oftentimes it's just a lot of cash just sitting in a bank because they have to hold the cash. Because if people say it's depending on what type of if it's car insurance, if people get into accidents, the insurance company needs the money to pay, or if it's if people die, they have to pay then the family. So you have to keep a lot of money on hand. It's called float. So he has so much in float, so many tens of billions in float, that he can use that float and buy things with it, like stock. Remember, that's how in 2008 we went into a great recession, because all these insurance companies and pension plans, they were using their float all this cash, and they were buying subprime mortgage bonds. So mortgage bonds are pretty safe investments. So the like a regular corporate bond was like yielding like 5% or 4%, and it's not like a risk-free investment, but it's a pretty low risk investment. Most bonds, but mortgage bonds were yielding like 8, 9, 10%. So it just seemed crazy. Like if there was another insurance company that was making double the return on their float than you are, and year after year they're making all this money, you kind of give in after a while and say, well, I'm going to buy these subprime bonds. And the more people bought subprime bonds, the looser they got with the lending. And then there was a trickle down effect where they defaulted. Bulldog, what's up? Bulldog, come join the stream. Hit the link. Yeah, come to this link. You could join. I need some help here. You're up 81% on new. Nice. Yeah, new. I really like that investment. I'm killing it on new. I got lucky. I'm not going to say like I'm this brilliant. I mean, I picked the bottom, but I got real lucky on new. Let's see. New holdings. I bought it in June 2022 at 424. So I bought it. I just happened to. I mean, I didn't get it at the very bottom, but the bottom I think was like 375, but I got it at 424, and now it's at over 11, so that's good. I'm at Cane's Chicken now with the wifey. Okay, no problem. So I'm up about 120, 130%. Let's see, 424 to 1127. I'm probably up more. I haven't looked at it. Wow, I'm up 166%. It's a Brazilian fintech. It's like a online bank, but they control South America in terms of online banking. Like Brazil, they're huge in Brazil, but they have a pretty good customer base in Chile, and a few other places. Was it Chile? I think Colombia, maybe. Revenue 1.7 billion, negative net income, but it's hard to look at net income for banks because there's a lot of mark-to-market adjustments. It's a Brazilian neobank in Sao Paulo. It's the largest fintech in Latin America. 80 million customers in Brazil, 1.5 million in Mexico and Colombia. Okay, so Mexico, Colombia. Mexico is a huge country, so there's a lot of potential in that country. It was 45 billion at the IPO, so it wasn't cheap stock at IPO. But I know Warren is invested in this, and Tencent the giant Chinese gaming company. 70% of Latin American population is unbanked, no access to checking. I do see a pullback, but I don't see it yet. There's just too much momentum and opportunity. And I just don't think earnings. I think earnings are pretty solid so far this year. Companies are reporting really good revenue numbers, really good profits. So it's not like if you look back into like the dot-com crash, when companies weren't really making any money and the stock was going up, that was just a crash waiting to happen. The subprime crash wasn't necessarily due to companies not making money. It was due to like the world collapsing. So they have a lot of big companies behind new. And somebody made a good point. A lot of Latin America and a lot of people in the United States, they just don't have a checking account. So they go to these cash check, those cash, what are they called? Check cashing places. So if you give them like $5 or $10 and they cash a check for you. So it's a pretty big fee. But these kind of companies are really beneficial to individuals that don't have a checking or savings account, which sounds crazy not to have one, but there are a lot of people who just don't have the ability for whatever reason. But why don't people? If you're an illegal immigrant, then you don't. I know some people in California who are from South America who don't have that paper, so that makes sense why they don't want to get a checking account. Among top 3 reasons consumers say they don't have a bank account, they don't have enough money, the fees are unpredictable, and they distrust banks. Okay, so a lot of people don't trust banks because a bank is a business and it might go out of business and not be able to give you your money back. That's happened before. But in the United States, that's pretty much impossible to happen, especially with the FDIC. But still, people are concerned. But I could see why people would be concerned banking in other countries, non-U.S. countries. There could be a lot of risk. About a fifth of those recently unbanked cite losing a job or significant portion of income as a reason for closing their bank account. The top cited reason unbanked is not having enough money to meet the minimum. Okay, so so they don't even have enough money to meet the minimum. I didn't even know there was a minimum. What is minimum to open a savings account, check account? I know there's a minimum to avoid fees. I thought there was like pretty much no minimum. Like you could even open up with $1, but the interest they pay for savings accounts usually make an initial deposit between $2,500 and $100. You'd be surprised. Some people can't even keep $100 in the bank. They need to eat. Among them, because I was talking to a friend recently about like I had a 3% mortgage. I was paying 3% interest on my mortgage, and I got so lucky that I sold right before the COVID crash. I sold all my stocks. Well, not everything, but I sold a lot to pay off my mortgage, even though it's 3%. And the stock market came right back up. So I would have made more money if I kept it in the stock market, but that's a different story. And he's like, why would you pay down a 3% mortgage? Like, that's crazy. You can make a lot more in the market. But the thing is, when you have money, you tend to spend it. So if you're making, $50,000 a year, you're probably going to live. You might have to spend more than you make, because that's hard to live on $50,000. But the more money you make, it's not like, so say the $50,000, you spend everything. Say you make, whatever, $35,000 after taxes. You spend it all on rent, food, any luxury items you want. And then if you get a new job and your salary doubles, I guarantee you're not going to save all the additional money beyond. So let's say you got $40,000 after taxes, and then you spent the entire $40,000 just to live, and then you got a new job and your salary doubled. So let's just say you have $70,000, your taxes go up. I guarantee you wouldn't save the $30,000. You would spend, maybe not all of it, but you would spend more. You would maybe buy a nicer car, maybe go on a vacation, possibly even buy a house or rent a nicer place. People just generally spend more if they have more money. It's so hard not to, because when you start making significant money, like more than you made before, you want to enjoy life a little. You don't want to still live where you're eating ramen noodles. So that's why I'm like, by having money in the bank, it makes it easier to spend. So I said, psychologically, by paying off my mortgage, it kind of forces me to live more frugally. What's your opinion on using leverage to start a business? I mean, I don't think it's a great idea to start a business. A little leverage is okay, but it's super risky because you don't make as good decisions when you have debt. And it's a lot easier to grow a business without having to pay the interest back on the loan. But I totally get it. Some people have to get a small business loan to start a business because they'll never start a business or never get a home because they just can't ever get that initial payment. So I totally get it, but it does make things a little more difficult. But you just got to live like you're starving to death. You can't, you go to dinner, be real frugal until you start becoming profitable. The epiphany is to get a better job and not settle being an underachiever. Okay, Sean, thanks for stopping by. So Canadian stocks. Yeah, I should do more Canadian. I remember I was telling people, I told this girl, I go, and this was in 2020. I told her Alimentation Couche-Tard. I said, I really like this stock. I think it was around this time, probably like around here, like the end of 2020. And it was 44 and it's doubled. And I remember her response. I was like, here's a good Canadian stock because she lived in Canada. And her response was like, I can't afford to invest in stocks. I don't have enough. And it's not like she wasn't making much money. She was doing okay. And I'm like, what? Like, you got to live, you got to retire. You're going to have some nest egg. Like, people just don't, they think like it's like gambling or something. She could have doubled her money and she would have gotten a small dividend, not a big dividend. So Asmin, are you mainly, what's your portfolio in terms of Canadian and non-Canadian stocks? Are you 100% Canadian, or are you half Canadian, half American, or something like that. The good thing about Canada is they have a really good commodity market. They have one of the largest shale reserves. They have a really good what's it called? Canadian railway, really good railroad stocks. Nutrien I like a lot. That might be a little inflated. Nutrien 50-50. I remember looking at this stock a few times over the years. It always looked really good, but so it's not really up too much since I looked at it. I remember looking at it. It's pretty much where it hasn't really moved. It did come up and then came right back down. Commodity stocks can be a little tricky. Canada has some pretty good banks too. RBC, CIBC, Toronto Dominion. So they have some solid banks. A lot of gold companies too. Supermarkets, Loblaw. Potash. Oh, potash has dropped. Yeah, that makes sense. A lot of good what's it called? Midstream companies. They're home to the largest midstream company in the world. Enbridge, not Enlink. Enbridge is the largest. Right here, Enbridge. So I'd have to look into some a little deeper. So what do you guys think? Any good Canadian stocks, you guys? In hindsight, he should have just bought Canadian banks. Well, he's Canadian. That they started in Canada. The Shark Tank was originally a Canadian show called Dragon's Den, and it was popular. And now it's more of an American show. So they're all Canadian, or most of those guys are Canadians, the ones who started it. Yeah, but I would I mean, do you like investing in commodity stocks? Shopify, that's another Canadian. That's a pretty volatile stock. That was up a lot, and now it's it got up to 160, and they did a 10-for-1 split, so it was up to 1,600 at its peak. Could you imagine getting it back then? It's still, I think it's let's see their price multiples. Wow, look at that PE, 765. Well, they probably have a really small amount of earnings, so that's hard to look at. But look at price of sales. It's getting more expensive. It's up to 14. It was as low as 8. Do you have any insight on knowledge as to why heavy capex companies like midstream companies prefer to carry larger than normal debt to EBITDA? Well, it's kind of the same thing with REITs. Well, a lot of midstream companies are MLPs, master limited partnerships, and REITs too. There's a feature for these two entities that they have in common. Well, two features. You don't have to pay income taxes, or they don't pay much in income taxes, and you have to distribute at least 90% of your earnings to dividends. So if you have $100 million in earnings, you have to give $90 million back in dividends. That's kind of like the setback to organizing your business as a REIT structure, MLP structure. That you do get to save in taxes, but you have to give out most of your earnings in dividends. So that's why, like, companies like who don't pay dividends, like Google, Microsoft, or they don't pay much. They keep all the money in house to grow the business. But these businesses, they can't keep all the money because legally they have to give 90% back. So there's not much money left over to grow the business. So the only way to grow the business besides equity is debt. So they have to take on a lot of debt to fund growth because they don't have much money left over. But if a company has 10 million in dividends, they can only keep 10% for themselves because they have to give 90% back to their shareholders, right? But they do benefit a lot because they pay lower taxes, and they get more investors because they pay a higher dividend. So they're able to scale faster, but they have to do it with that. There's really no other way. And it's not just growing the business. When you have a high capital intensive business, you have to maintain your CapEx too. So there's part of the CapEx spend is to say you're you're an oil and gas midstream company. So you have, say, 10 billion of pipelines that you developed, and say you have 2 billion to put towards CapEx. Well, 1 billion is just to maintain this 10 billion. You have to, maybe upgrade the pipeline. You have to fix, maybe there's problems with it. So just the maintenance alone could eat up half your CapEx. Then you have only another billion left over to grow the business, to maybe add more pipeline. Blade. A lot of it is to get the tax break, so they avoid double taxation. I mean, they could organize the business as just a regular, C corp or S corp. They could do that, but they wouldn't get the tax incentive, and they wouldn't be able to offer like a 6% yield. You ever see these like REITs or MLPs offering like 5, 6, 7, 8% yield? They couldn't offer that. It would, if they had to pay taxes, it would be a 4% yield. I mean, that's, let's see what why do capital intensive companies, and it's the same reason why tech companies have usually hardly any debt. Like I remember Meta was like debt free for a long time because they don't need to build anything. It's just all about like brain power and like personnel, and Why do companies use so much debt? High debt to equity ratio indicates a business uses debt to finance growth. Companies that invest large amounts of money in assets and operations often have a higher debt to equity ratio. That's definitely part of it. The taxes, but it's just more expensive. It's to grow your business. It's very expensive. But I was focusing on midstream companies. Well, then if you're talking about midstream companies, then it's they're usually MLPs, master limited partnerships. So they have to take on debt to grow. But even a regular company that has a lot of CapEx spend is still going to have a lot more debt than like a company like a software company that generally doesn't have much. It's just a lot easier to scale and grow if you're what's it called? Like QuickBooks. What company makes QuickBooks? Salesforce, right? Salesforce. If you want to sell your product, the QuickBooks software, people use it for their accounting purposes. If you want to sell it, say to 1 million people in the United States, or to 1 million people in Canada, or 1 million people in Brazil, it's not that challenging. There might be some kind of like rules and regulations you have to apply for, but to get the product to the person, it's pretty much over the computer. They don't have to. It's very easy. You can, with the same 5 people, you can sell 1 million new products to 1 million new people with the same 5 employees. It's very easy to sell software, right? But if we wanted to sell to 1 million new people, we wanted to provide them with oil, or provide them with a product like new cars. It's expensive. If we have to provide 1 million new cars, it's not like these same 5 employees can just okay, he has 1 million new customers, provide them new cars. No, you have to build the factory. Then you have to staff the factory. Then you have to, it's very expensive, and to build all this machinery. Secure Energy Services, a Canadian public energy service company based in Calgary, Alberta, specialized in oil field waste treatment and disposal. So it's just kind of, but you need to compare it to others in the industry. Like you can't compare like the debt to equity ratio of like a grocery store to an oil and gas midstream companies. So if your debt is equal to your equity as a midstream company, you're probably doing okay. But if your debt is equal to your equity, as most other businesses, you probably have a ton of debt. So like the average debt to equity ratio for midstream companies, 1.3. So for every dollar of equity, they have $1.30 of debt. So if you were like another company, like it's wow. The average specialty REIT has a debt to equity ratio of 5.3. That's why it's hard to look at these things, because like this one company, Iron Mountain, is 68. So it makes the average look really high. So telecom usually has a lot of debt to equity ratio, high debt. Yeah, that is definitely good to grow the business, but you have to be careful, because if rates go up a lot, you can be toast. So you want to have a healthy debt to equity ratio. Average is 1.3. So like Enbridge is 1.3. Like Cheniere is 5. So it might sound a little rich, but you just want to maybe look at their financials a little deeper to see. But it is harder to grow when you're in a capital intensive industry. But it seems like a lot of industries have high debt to equity. I guess even banks. Well, okay. This is all screwy because, wow, Business Quant Access is on sale for $19 a month. They gave it to me for free. I actually like it a lot. It's a bit like old school looking, but I do like it a lot. I'm not just saying that to get you, but they did give it to me so I can like do what I'm doing right now. I can use it and tell you about it. But I do use it a lot. I use it every video. Footwear and accessories. So it seems like every industry has a good amount of debt. I was thinking it's pretty low. You would think REITs would definitely have a lot of debt. Resorts and casinos, that's only 1.1. Semiconductors, well, that's really low, 0.4. Because I guess most semiconductors don't do manufacturing. Like Taiwan does, and they have a low debt to equity ratio. So if you want to get into semiconductors and you feel NVIDIA is too expensive, I highly suggest Taiwan Semiconductor. Because without Taiwan Semiconductor, these other companies wouldn't be where they are today. Because Taiwan does all the hard work. They do the manufacturing. But yeah, any other... I'll be right back. 1 minute. Taking over the channel, invest in the latest crypto scam links and comments. Yeah, if anybody wants to invest in a scam link, go to so there's $5 trillion companies. This might be an old article. This is probably before NVIDIA. NVIDIA's on this. So this is a few months old, not that old. So Apple, Microsoft. Apple has come down. Apple almost was at 3 trillion at one point. What are they at now? Well, not that far off. Apple, Microsoft, Google, Amazon, NVIDIA. So 5. What about Meta? Is Meta 1 trillion? So that's 6. Any other trillion? Let me know if anybody wants to be a guest. You can click on the link and then be a guest on the live stream. So there's $6 trillion companies. Is there any other $1 trillion companies in the market besides Apple, Microsoft, Alphabet, Amazon, NVIDIA? I feel like there's probably one more, right? Apple not joining AI wave. Yeah, Apple, I think people are concerned. Apple's not embracing AI. And Google is, their AI search was a flop. Like it was providing the results just didn't make sense when people were trying to use Google to search, to use AI. You would say who was the first U.S. president, and it would show a black president or something like that. The results weren't making sense. Or I think people must have it was users probably screwing around. I don't know why. Gemini, a chatbot based on companies' advanced AI technology. It angered users last week by producing historic images and blocking ahistoric. Is that a word? Ahistoric? Okay, without concern for history or historical development, indifferent to tradition. Okay, yeah, the controversy morphed over the weekend into a broader backlash against the chatbot's responses to different philosophical questions. Okay, yeah, you guys probably heard of Gemini problems. Meta's been doing great with AI. They were on the AI train. I mean, not exactly AI, but pretty much. The Meta world is similar to AI. It's kind of like the same concept. So they were on that trajectory well before anybody else. They even changed the name of the company from Facebook to Meta because Zuckerberg had the vision, but Gemini stemmed from modifying user prompts. Poison with postmodern Marxist nonsense. Market, please keep shorting Google so I can buy at a decent price. Well, if the market shorts Google, it doesn't mean it's going to go down. what other companies are good to do DCF on? Let's see, what is it? Okay, since 1990, midstream sector saw a drop of about 46% in the capex. Seeking alpha. Debt can be good. Understanding debt from a REIT and midstream energy perspective. Can't look at the article. Meta is doing what OpenAI was supposed to do, making all their AI code open source. That's Federal Reserve. Analyze the nature of debt issued by midstream MLPs. So is that guy still here? Oh, okay. So it mentions what I was talking about before about how they have to give out most of their earnings and dividends. Given that MLPs distribute a portion of their cash flows to their unit holders, because they have to give 90% of their cash flows back to the unit holders or stockholders in dividends. MLPs have been dependent on funding growth by raising capital either through equity or debt issuances. Because, I mean, that's pretty much, there's three ways to make money. You make a profit on the product you're selling. That's the best way. Or you take on debt, or you dilute your shareholders. Those are the three ways to make real money, a significant amount of money. I mean, anybody can make money. Like you can I guess do these side gigs to make money, but like to make significant money for a business, those are three ways. Recently, this has been changing with a number of LPs seeking to move to a self-funding model by retaining more cash flow to pay down debt and fund future growth opportunities. Given the recency of this shift, however, many LPs still have leverage ratios, debt to EBITDA earnings between 4x and 5x, meaning debt continues to be an important part of the capital structure. According to our research, 78% of midstream debt is fixed in nature, meaning coupon payments mean same throughout the life, 70% of floating rate. At the entity level, the real Gary Gensler, what's up? VOD, 99-cent dividend, 11%. Video on demand, Vodafone, 11% yield. Whenever you see a yield in the double digits, run fast, run away. You're going to lose a majority of the time. Your stock price will get cut dramatically. There's usually a huge sell-off because the company can't maintain those levels. The stock it's $9. It was over 70 at one point. Now it's 9. The price of sales 0.5, PE of 2. When people see this, they go, "Oh my God, it's such a good deal." But the reason people are not buying the stock, and a lot of revenue, $45 billion of revenue. It's a lot of revenue. And they're profitable. Look at that, $11 billion of net income. Look at it, look at all that free cash flow. So it looks so good, right? It's so appealing. But what's the catch? Something's not right. The option flow on VOD is wild. Where do you guys go to see short interest? Like, either what's the percent of how many shares are shorted, or hedge fund short interest? Like, where do you guys go for that? There's a lot of sources, but I kind of don't trust a lot of places. Let's look at it on a German stock exchange, so I don't have to convert anything. Okay. I don't know if this is going to work, but let's see. Let's go back. I feel like something's going to get screwed up. I'll just do a 9.25. And the euro to US dollar is almost 1-to-1, right? So yeah, it's let's just do that. It's probably easier. I Google top shorted stocks. That's how I found Academy Sports and Outdoors to 30. That's the way to do it. Google. $2.9, 3, 3.4. Okay. So I'm at $13. They're trading at $9, and you get 11% yield. It is a European stock, so you might not get the entire 11% because they might take a little out from taxes. I'm not actually, no, maybe not. I don't know, because this is probably ADR, this Vodafone. So anything of course, all the dividends you get will be in US dollars, but so why is Vodafone dropping so much? Let's look at the RSI. RSI, it's a pretty good RSI, 49. And it's been like around 40 to 50 for a while. So it looks like a good entry point. It was over 20 in 2019. It really started coming down mid 2022. Yeah, we got to set up a shell company so we don't have to pay taxes. Is Vodafone going to be taken over? A lot of red flags. Let's see if there's any. Swisscom is advanced talks to buy Vodafone for $8.7 billion. But what? It's $25 billion. That doesn't make sense unless they're buying part of the company. Sell Vodafone. Vodafone Italy. So it's just part of the company. for $8 billion. It's just a unit of Vodafone. Just the Vodafone Group recently noted media speculation and confirms an exclusive discussion of Swisscom. Infinite Reality and Vodafone announced to unveil revolutionary automotive onboarding service. Vodafone, all signs pointing up. Iliad offers Vodafone to merger ops in Italy. So it looks like a lot of people are trying to buy their Italian arm. Vodafone declares the interim dividend. I think it looks like the dividend's going to drop a lot. I think they're going to have to cut it. I don't think they can. So the dividend, so 50 cents. It's been 50 cents. It's a semi-annual dividend. So they pay it twice a year. It's been 50 cents for a while. They were paying over $1. One dividend over $1 and 150 cents. Yeah, it looks kind of risky, but I don't know. It's a British company registered in. So it operates in 21 countries. Telecommunications IT services in 150 countries. I think the market is thinking that their technology is going to fall kind of flat. It's not going to keep up with the emerging technology. I think that's the big fear. What do you guys think about Vodafone? Do you think Vodafone technology? What technology is Vodafone a technology company? I guess you just got to look at what companies can support, like NVIDIA and other AI companies. I guess that's where you got to put your money at this point. What companies support NVIDIA? All right, Cloudflare. They're the largest, what's it called? CDN company in the world. Content delivery network. Because I just did a video on Fastly. And Fastly is like the 5th or 6th largest content delivery company. I showed this chart in a video. So Cloudflare is number one. Amazon Web Services number two. Akamai, I did a video on Akamai, and they've been in the Cloudflare, the CDN industry, I think the longest of any company. CDN is extremely important part of the internet, because they're the companies that keep like this video from not freezing every 5 seconds. They're the ones who make sure websites are able to people can view content on websites. It's mainly like videos, because video, like one video can drain more energy than like 10,000 pages of words, because there has to be like a lot of loading time. Do you guys remember? I don't know if anybody remembered in the late 90s, like AOL, when you did a dial-up modem, and then you had to wait like 20 seconds every time you went to a website to load the page to view it. I mean, it's so much more intense these days because of all like the advanced features on pretty much any website. So Cloudflare is the largest company in this industry. And like they support all these massive companies like Google and Meta and YouTube. So, I mean, to explain it simply, so content delivery network. So they have these servers all around the world, and that's how people, like when I went to this web page, my network went to a CDN. So I could pull up the web page and view the information, and within a split second, I was able to open up this web page, because the server is probably pretty close to my house. But if you live in like certain places, like certain countries, you might not have servers that close, and it could take, you might not be able to go on a web, or it could take forever to load a page. So but you can't have just one server like in the middle of the world, you have to have servers like pretty much in every country. Mike, thank you for the Canadian donation. I appreciate that. And so if you want, like, this is Russia, right? Wait, Russia, right? Where's China then? China's near Russia. If you want like people in Russia to have high speed, you have to put these servers fairly close to at least the country, maybe on the border of a country, or possibly in the middle of the country. And of course, it's expensive. It's a lot of infrastructure, and because obviously you want everybody to have high-speed internet, but you can't put all this infrastructure in every single country. It's just too expensive. You have to have a lot in the United States, because that's where generally a lot of companies' revenue is from the US, and certain countries in Europe and Asia, especially densely populated countries. But let me know about if you guys know about CDNs, because I don't know that much. I'm just trying to learn about it. I kind of have a high level of this stuff, but I do want to. kind of, it's just interconnected services that speed up web pages for data-heavy applications. But I know it's not that straightforward, and it's probably pretty complex once you get into the details. It's kind of like driving a car. It's pretty straightforward. It makes sense. The purpose. You put the key in, the ignition turns, and then you're able to drive it, and you can stop, you can speed up, you know how to reverse. But if I tell you, like, okay, now take the engine out and fix something on it and put the engine back in, that's pretty complex, right? It's kind of like anything. Like, I understand this stuff, but I would like to understand it a lot better. But these companies are so crucial in making the internet run, because without these companies, it would take forever to load things, especially videos. Like, just to look at words on a page, you don't need that much power. But if you're going to watch a video, or if you have like 50,000 people in your city watching a video, you need these pretty advanced systems. Akamai is one of the first, if not the first companies. Yeah, Akamai was real early in the process, and they have a pretty big market share, especially in enterprises. They're not as big, I think, in small and medium-sized companies. Well, it looks like they're even, but you can have two enterprise companies. You can have, if Google is your customer, Google equals the revenue for about 1 million small and medium-sized businesses. Like, so that could be. Microsoft Azure. So like Amazon Web Services, they also are a CDN provider, in addition to the largest cloud company in the world. They're like 1/3 of the cloud computing market. AWS, 32%. Azure is 20%. Google, Baba is 6%. IBM, Salesforce is 3%. Tencent, and Oracle. So AWS not only controls 1/3 of the websites in the world, it also has the second largest CDN provider. Copart. Yeah, Copart. Somebody just commented on my Copart video. Look at this guy. You have no idea what you're talking about. $19 price target. Copart, the vehicle, automotive. Yeah, the auctions. Yeah, the auto auctions. That's a pretty good business, right? 54, 52. %8 whack. Yeah, I did a couple of videos on Copart. Well, it's up 50% in the past year. 1.2, 1.3. So I'm at 23. I'll grow it more. I'll give it like 1.6. I'll lower the WACC. Yeah, I don't see Copart as being a good value. Oh, look at that. They're 28, which is like where I'm at. What's the analysts? Average analyst at 54. It's really come up a lot. Stock has done really well. Wow. Look at its growth. It's up like 50x. So I'm at like in the 20s. So where it was a year ago is where I think it should be. So I think it's overvalued. Stats. Okay. Forward P of 37. Price sales of 13. I don't know. I'm not seeing it with Copart, but that could be just be me. MGA. Oh, this is a foreign company? Metals Grove. You think Copart is going to grow like NVIDIA? Oh, it's Australian. Great. This is the problem with non-American companies. There's just not a lot of information. Yes, I run it from my garage. Exactly. It's a tough gig, but it's working. They should give me a free. They should give it to me for free. Simply Wall Street. They they contacted me and they asked me to like kind of like sponsor or like kind of promote their channel, and they'll give me a cut. Seeking Alpha just emailed me recently. They're gonna give me a free free access to their website. I just have to kind of, I guess, put a link in my videos to let them know. And then I think I might get like, if somebody joins using my link, I get like 50% of the cost, something like that. Yeah, Simply Wall Street is Australian. It's a nice website. It's like, it's visually, I think, the nicer and easiest to use. I think Yahoo Finance You get all the information, almost all the information from Yahoo Finance. I just picked Simply Wall Street when I started doing videos, just to have like kind of more things to talk about in the video. But it's not like I did a lot of like deep analysis of like what financial website is the best to use. I just Googled like to try to find a website that valued a stock. That's pretty much how I started. And I just found this. So I can show like, here's my price target, and I could show another website's price target. That's, yeah, affiliate marketing. I do the same affiliate marketing with Simply Wall Street, but it's hard to get someone to join using your link. It hardly ever happens. I could imagine people have joined but didn't use my link just from seeing me talk about Simply Wall Street, and eventually kind of like it's ingrained in their memory. Depends who the author is, though, the article you read. Had any companies offered you shares to cover or hype their stock? No. There was a company for like 2 years in 2020 and 2021. They were paying me $500 to make a video. Like it was a marketing company, and they worked with like, usually it was like these small cap. It was a lot of Canadian mining companies for some reason, but like it was like a small cap stock, like 200 million market cap, and they wanted to get more like publicity. They want more people talking about the stock. So they went to this marketing company. I don't know how much they gave the marketing company, but then the marketing company would contact different YouTubers, and then give us money. So it was really based on views. So they gave me 50 cents a view. So they said, since your average video is 1,000 views, every time you make a video of a company we asked for, we're going to give you $500. That was the only time I made money on this channel, is when I was working with that company. And I think 5 times they gave me $500 to make a video. And it wasn't like I was making much money. I never really made more than $1,000 a month from this channel. I think maybe I made $2,000 a couple times because of that marketing company. But generally, I'll show you. See, I made $350 the last 12 months. It's hard to make money. Like, it's almost 4 years, because I started this channel in 2012, but I wasn't making videos. I just had a YouTube channel. I started making videos in May 2020. So from May 20, so it's 4 years, a little less than 4 years. So I made $20,000 in 4 years. So I never really made enough to even pay my medical insurance off this channel each month. So I couldn't live on it. It was just more like a hobby. But like I said, I'll show you if you're curious. It's hard to. Okay, I'll show you how much I made. I stopped keeping track of it after the past year or so, but I'll show you how much I made each month. Don't tell the IRS, because I'm joking. I guess I could just show you on the screen. So in my first, I started the channel. Yeah, I mean, it's okay. 2.5, yeah, 2.5 million views. So I started the channel in May 2020, and it wasn't monetized until October 2020. So it took me 5 months to get monetized, because you need 1,000 subscribers and 10,000 hours of view time. I can't remember what the numbers were, and it might have changed. So it's more of a hobby. It's not a. So I made $144 my first month of monetization. Then 303, 303, 525. So I was stoked. I was like, oh my God, it's growing. Then I made 800, 900. So this is like the peak. I made 900. Then I got a sponsored videos. So they were paying $400 when I first met them. So they gave me $1,600 for 4 videos. And then I got a sponsor here, 500. So only in November 2021, YouTube paid me $1,000. December was the best YouTube month in terms of ad revenue, $1,400. So I was really hoping, and I made a stupid decision. I ended up selling my business thinking I was going to focus on YouTube. I did kind of want to sell it a little bit anyway, but I thought I could just focus on YouTube. But you can see I haven't kept track of it since June 2023, but you can see $130, $360, so $1,449. That was the best, and it's a few $100s. So I can't even pay like I probably spend. I mean, if you don't include my time, because I'm making minimum wage, or I'm not even minimum wage. I'm making like $3-4 an hour. But I do have to pay money. Like I have Simply Wall Street. I think I don't know what that is. $20 a month I pay on average. I think I might pay for a year up front, but I got FinViz. I just paid for that recently, so that's probably $20 a month. This streaming app I'm using right now, I think it's like $30 a month or something. I paid for a year up front though. And then there's this Storyblocks where I get the videos from my. So I probably pay like $60, $70 a month for all these things. And I've done raffles before. Yeah, don't tell the IRS. Please don't tell the IRS. Wait 1 second. We're dog boarding and somebody's picking up their dog. You got it? We're just cleaning the ball. Okay. So everything I made, even if you include all the sponsorships, maybe it's like 35,000. And I wasted a lot of, I think I probably spent like 15,000. The biggest waste of money as I spent all this money with these different companies. In the beginning, I was paying like someone to make a thumbnail for me. And then there were parts I was paying people to edit my videos. Now I do everything by myself, but so I probably spent like 1,000 in thumbnails, like a couple thousand editing videos. The biggest waste was a few different companies, like these YouTube consultants. Like they would charge me like $5,000, and they would give me like 20 hours of coaching to help me grow my channel. And I never saw results from that. It was the biggest waste. So I probably spent like, I don't know how much, 20,000 from all those. Do you factor in the money made from stocks? I make the assumption the work you do on YouTube influences. No, I don't consider that. That makes sense. I think I definitely made money with certain stocks. I think I lost money with certain strategies. I kind of wish I stuck to my regular strategy. I guess I've done well with my trading since the channel. I don't think it's changed much. Of course, I made a lot of money from stocks. I don't know if it would have been different if I didn't have the channel. I would have still. I was investing a lot well before the channel, but the channel it definitely had me. There's a lot of stocks I wouldn't have looked at if it wasn't for this channel. But especially when people when people pay me money to make a video, or just people suggest videos, and I start making like doing the video and editing it. I do learn a lot about that company. I wouldn't have probably looked at most companies. So that's true. It's just more for fun. If that's the case, then I'm not going to open an OnlyFans account. No, you got to do it. Open OnlyFans. Copart. So I did a video in December 2023, February 2021. Let's see. So in February 2021, I had them at $68, Copart, 16 billion market cap. The stock has done really well. That means a lot. Yeah, I'm the only influencer you're tipped. I appreciate that. Yeah, I guess this Copart, it just seems overvalued. Like, why do you think? It's just it's car auctions. People auctioning cars. Why do you think it's so much more valuable? They do have a lot of cash flow. 900 million of cash flow, and 4 billion of revenue. So they convert a lot to cash. Not really. I used to do covered calls more until I got called away some of my stocks, so I stopped doing it. It's hard to see the. Let's see if we'll do. Let's see if NVIDIA options would pay. Like it's so hard because the option premium. They get a few thousand views, nothing else. Yeah, I think the benefit is just me kind of learning. So let's say they make this hard to read. It's at 823. This, if it's blue, it's in the money. I'm looking at options. Now, I mean, I'm more than welcome to listen to ideas, but I've tried a lot of different things and nothing works. So I've just accepted the fact that I'll never make money on this YouTube channel. It's okay. I'm not upset about it. I have an idea, bring a ton of views. Do you do videos on companies that start paying dividends? I struggle to find NFM and dividend. Yeah, I've done a lot of videos on companies that that start paying dividends. You mean companies like Meta who are going to pay their first dividend? Or is that what you mean by start, like for the first time? Okay, so this is the options chain for NVIDIA. Okay, I'll look into that. 823. $823. So that's what they're currently trading at, 823. And it's 2 trillion. I hate this freaking thing. Okay, you ever use unusual whales? No, I never heard of that. What is that? Unusual whales? Okay. So $1,000 means the stock has to go up a decent amount. So 22%. I mean, it definitely could hit 1,000. Oh, but what's the? Oh, this is all. This is not going to be good. I don't want. I can't have the option expire next week. Okay, let's do. It's March. Let's give it at least 3 months. because it's because when you do options, it's timing is probably the most important part of the option. Okay, so I'm doing $1,000 strike prices. So that's my target. Okay, and the bid is 32. Obviously, the higher the strike, the lower the bid. Let's do $1,100. So it has to go up 34%, which is right here. Changed 30%. It just why does it say 30? Oh, that's not the price of the underlying stock. That's the number of options that I'll purchase at this price. 30. It's the number of options increased. So yeah, let's do 1,100. So so the bid ask. Are you guys familiar with buying options? I'm doing I'm gonna buy a call option. Options are a horse race. Just go back to the track. So I'm gonna buy a call option. I'm just doing this for fun too, so to show you guys how options work, and also to show you how ridiculous the premiums are. How you can't. It's so hard to make money with options. Every time I try to buy options, it's almost like. But anyways, okay. So we're gonna do 1,100 strike, and what was the date again? I wish this was a little user more. So June 21st expiration. $1,100. So the bid ask, generally you go between the bid ask, because obviously you want to pay as little as possible. So that's why the bid is always lower than the ask. And the person selling the option wants to sell it for as high as possible. So between the bid ask, so which is the last price, so $18. That's for one contract. That's for one contract. $18. There's 1,000 open contracts. So it's a decent sized volume. You see the $1,000 strike price, there's many more open interests. But as you get further and further out of the money, there's less. So for one contract, you have to pay $18. And each contract controls 100 shares. Okay, so strike. Okay, price. Cost. So you always times it by 100. You have to have insider information to be successful with options over a long period. Yes, that's true. To be successful over a long period of time. So you get lucky. I've gotten lucky before. So that's the expiration date of the option. So you have to pay. Okay, so you have to pay $1,800 to control 100 shares of NVIDIA at 1,100 strike price. So if you did it, if you bought this, it's trading at 823 today. Okay. So let's just say, what's the target? So let's see the target. So say, so obviously if it goes to $1,100, you're just kind of, you can't even get anything. It has to break through $1,100 for you to even make money on this option. Unless, I mean, if it did move up to $1,100 real fast, say in 1 month by April 3rd, then you could probably sell the option contract in the open market and probably make a little money off of it, because the value of the option would go up. But let's just say you weren't looking to trade the option. You were just looking to either execute on the option or just let it expire worthless. So if it did hit $1,101, let's just say for fun, it's on June 20th, it hits this target, then you can sell the option for $100. So okay. So I don't, if you know about options, I understand you can trade the option and possibly make money before even, but I'm just gonna assume we're trying to make money off of the price breaking through $1,100. So if it hits 1101, you lose $1,700. You paid $1,800 and the option's worth $100. Do you guys understand this? Do you understand how it works? It might not sound straightforward if this is one of the first times you're seeing options, but the way this option contract, I picked the 6/21 expiration date. If I picked an earlier expiration date, like in April, it would be a lot cheaper, the option. It would maybe cost me, here, let me show you. Let's just say I picked April, so it's only 1 month out. So I'm not giving myself much of a chance, because in order for the stock to hit $1,100, I need time. It's not going to happen overnight. Okay, so this is March. No, what am I talking about? Okay, 621. Okay, all these expire 621, and all these expire, what was it? April 8th? April 5th. Expiration April 5th. We're still doing 1100 strike price. But look how much cheaper the option is. It's $2. So for only $200, I can control 100 shares of NVIDIA stock at 1100 strike price. For the June option, it's so expensive. I have to pay $1,800, 9 times more money. Because for the June option, I have 2 extra months for the stock to go up. I have more of a chance. In this case, I only have 1 month. So the stock has to go up 34% in 1 month just to break even. Then it has to go up. Let's see what. Let's see. What's it? 1150. Oh no, I got to get my 1800 back. What am I doing? 1180, 1160. Okay, so if it hits $1,130, wait, the target. All right, I'm doing it right. I'm thinking, what am I thinking? Okay. So the strike price is 1100. I paid $18. So you have to pay 18 times 100 shares. So it cost me $1,800 to enter into this contract. NVIDIA is trading at 823 today. So just to break even, NVIDIA has to hit 1118 by 621. Say it hit 1118 on 621. Then I could sell the contract for $1,800 because it went $8, $18 above my strike price. Because my strike price was 1100. If it hit 1118, it beat it by $18. And I own 100 shares of NVIDIA. So I can sell the contract for $1,800. And that would just break even. That would just cover my costs. because I paid $1,800 for this option. So the stock has to go up 36% just to break even on this call option. This is a little better because it's cheaper. So every dollar past 11.18, it's profit. So let's just say it hit 11.40. The contract is worth $4,000. I made a profit of 2,200. Let's just go extreme. Let's say it hit $1,300 a share. I would make 20 grand. From an $1,800 investment, I would make 20 grand. That's called leverage. That's because the stock only went up 58%. It only went up 58%, but my return was 1,000%. Because if you just buy NVIDIA stock, if I just bought a share for $823 and say it did hit 1,300, I would have made a 58% return on my investment. But if I buy options, I get 1,000% return on the investment. That's crazy, right? And the reason it's so much easier with the April calls is because you only have 1 month for the stock to go up 34% just to break even. But if it's pretty unlikely, but that's why the guy but in this April one, if in 1 month NVIDIA went from 820 to 1,300, I would make a 9,900% return. That's why the guy Roaring Kitty, it was GME is ticker. He turned 50,000 into 50 million because of options. You can't do that with regular stock. Because even if you put 50,000 into NVIDIA, like how much should it go up? Just a regular stock. I mean, of course, you would have to wait a couple decades, but NVIDIA went up real fast. But let's just pretend you got in. Let's just do 10 years ago, because 10 years is still a long time to wait. But let's just say you bought 10 years ago at $4.60. And now it's trading at $8.23. That's even 7. Oh no, wait, not 7. I guess in NVIDIA's case, you could have made a lot of money if you bought 1,000 shares, but you had to wait a decade. That's a long time to wait. Yeah, can have huge unrealized gains buying call options on companies that pump from the time you bought the option at a time. But the problem is you got to time it so well with options. Look at this. I guess if you would have bought options in January, you would have been a multi-millionaire. Well, it's hard to put so much money to options, but like if you got options It's really about timing it. That's a problem with options. You can predict a company stock price to increase, but if you time it wrong, you'll lose. You'll never make any money. This is just the craziest thing ever. That's not normal. Yeah, I beat up the keyboards pretty bad. Damn, I wish I would have. I mean, it's so easy to look back, but if we would have known in January, I wouldn't have bought NVIDIA in January. I would have bought options. And the SEC would have looked at my investments like, how did he know it was going to go up so much? Because probably it's getting more expensive to buy options on NVIDIA. It was probably a little cheaper back then. But that's why Roaring Kitty made so much money. Even though you could make 1,000% return if the stock goes up 58%. When he bought it, you could have made even like how do you turn 50,000 into 50 million? Yeah, that's about a 100,000% return. Yeah, it's only options. You can't do that just buying the stock. You can't. The only way you can make 50 million buying a stock is if you have like at least 100,000 that you can put into a stock. But you would have to wait 10 years. I guess for NVIDIA, you could have done it in a year because it went up like about what, 10x, 800. Why are they so annoying? Yeah, it went up 100. So it went up 8x in a year and a half. I mean, 800% is a great return in a year and a half, but if you want to make like $10-20 million, you can't do it in like a year or two unless you buy options or unless you already have $1 million to start. Like if you had $1 million to start and you put it into this stock a year and a half ago, you could have turned $1 million to $8 million. But if you want to get like tens of millions of dollars like Roaring Kitty, it has to be options and it has to be stocks that nobody knows about. Does that make sense? The options? I want to do the opposite. And I want to do why is this I want to do put options, but I don't see put options. Oh, here, puts. I want to do puts. I just don't know when. Maybe I'll do May puts. I want to do like maybe $600 puts. I mean, I couldn't drop like, it's a risk. It's a risky investment. It's like kind of like, it's much riskier than just betting all on red and roulette or all on black, because that's almost 50-50. This is like, you have a 95% chance of losing everything. I mean, so I can't like drop like $1 million. Like I don't have $100 million. It's not just a roaring kitty. Congress does it all the time. Yeah, that's true. Nancy Pelosi made a lot of money on. So I'm going to buy, I think this is what I want to do. But I just don't know when. I don't want to time it wrong. May 17th. So I want to do, I want to put option. I want to do a 600 strike. So that's kind of saying the stock will go down 93. Oh no, I put the wrong 600. It has to go down 27% just to hit my strike. Let's do a $3.30. It's usually between the bid ask. Well, last price is right there, $332. So $330. I'm reading a Schwab article right now. Options, delta, probability, and other risk analytics. So the cost is $330. It's trading at 823 today. Let's just, it has to hit 600 just to kind of like hit my strike price. That doesn't mean it has to go down to like 597 just to make money, I think. So I only have 2 months for the stock to go down. If it goes down 28% to 596, I'll break even on my options contract. But if the stock comes down a lot more, say to 500, I'll make a 2,900% return. I'll make like $9,700. And if I do this, say I buy 30 contracts. I'm going to buy 30 options contracts. It'll cost me almost 10 grand. So I would make $300,000 if I bought put options on NVIDIA. It's May 17th, so I only have 2.5 months. And the stock, if it goes down 39% in 2.5 months, I would make $300,000. But I have to put up $10,000. That doesn't seem that bad, right? That's what I want. I want to do that with AMC. I wanted to buy calls on AMC when they were doing the short squeezes. I was going to put 50,000, but my wife wouldn't let me do it. But I would have made like 500,000 if I did it. I'm so annoyed I didn't do that. Best of both worlds. Huge monthly income potential, long-term growth. Yield Max ULTY was recently listed. It provides monthly distribution that contains stock options and companies on huge. ULTY. But when you buy calls and puts, you can't lose more than what you put in. So it's not like an infinite risk. When you sell uncovered calls, if you don't own the stock, there's unlimited risk. Like with NVIDIA, you could have lost millions. What is this? Is this a new? Oh, this just started trading. $20. Yield max ultra option. Expense ratio 1%. It's not terrible. There's no options, of course not. I don't know about this one. The implied volatility underlying should produce massive income. Heaven help us during a market correction. I imagine the beta. This basically is what one would do if one were both sufficiently capitalized and experienced enough with the basic cover call strategies. It should produce some good yield income. Nice diversification. Took a modest position, 954. Why not? YOLO. I don't know. So what do? They buy high yielding stocks? Is that what? Yield max ultra option. The fund aims to obtain current income and to seek exposure to the shared price of select U.S. listed securities. What does it invest in, though? What securities? I don't know. I guess this was a long stream, so I think we're all. Yeah, I have Energy Transfer, so I do own that. That's an MLP. But okay, yeah, I'm gonna sign off. I guess I'm getting tired. Thanks for joining. And I'll thanks for the comments. And I'll see you guys next weekend. Okay, have a good one.